8 minutes till the bell, and it's a close call. Stocks are trying to pull it off. Bonds certainly have, recovering all their losses throughout the day. Nate Peterson joins us, Director of Derivatives Analysis, and Cooper Howard, Director and Fixed Income Strategist at the Schwab Center for Financial Research. Gentlemen, good afternoon. How about that bond rally, Cooper? Get us going here. Wow, what an amazing comeback.
Yeah, it was quite the move in bonds today. So we saw, obviously, after the CPI print, not as good as expected. So it was worse than expected. A little bit of a increase in yields. And then all of a sudden throughout the day, they started to trend a little bit lower. But I think it ties back to Fed policy. We heard from two Fed officials today kind of pushing back against the market's expectations for an earlier than expected rate cut. So I think that that's really one of the bigger reasons why we saw a little bit of a decline in yields today.
Oh, wait, tell me about that, okay? So they push back on the March cut, yields go down. How come?
I think that that's really an interesting thing. I think that the market's really trying to navigate between where inflation is potentially going to go and what Fed policy is going to be saying. I also think that the market's probably gotten a little bit over their skis in terms of expecting the number of rate cuts. Right now, the market's about 5 to 6 rate cuts, with that first one being in March. But we've really penciled in, Oliver, about 3 to 4 rate cuts, potentially the first one starting in May. Okay.
Is it the market for bonds saying, is it trying to tell the Fed that if you don't cut, the economy is going to get blasted? Because I guess that would, long yields could go down if they don't cut and put the economy at risk. Is that some of the logic here?
I wouldn't necessarily say that that's the logic. I think that if you look at kind of the check boxes that are required for a soft landing, a lot of them we're getting to those check boxes. If you look at the Fed's dual mandate on the employment front, it's hard to argue that we're not at full employment, and it's hard to argue that it's not seeing major cracks in that part of the market or that part of the economy. But then looking at the inflation picture, yes, today was definitely not as good as expected. We'll see if PPI tomorrow is going to kind of confirm that. But we've always been in the camp that getting down to 2% is going to be a long and bumpy road. So we don't necessarily think that it's going to be a straight line down.
All right. Nate, what do you think about stocks' response to this throughout the day? It seems like bonds have a lot of conviction. Equity's a little bit more mixed. It seems like we're going to need more to convince the Russell Bulls to come back into the fold.
Yeah, no doubt. And you can tell based on, the 10-year yield is a proxy. It's about to close at the low of the day, which is a 1-week low. Earlier in the session, when stocks were near their lows, we were around 4.06 on the 10-year. That would have been the highest close since December 12th. So, yeah, they came in and they bought bonds there. That's a little bit interesting to me, a little bit wonky in the sense of, it's kind of hard to pinpoint exactly what the market wants to do here. But technically speaking, you can see how tentative the S&P 500 is as it gets near that 4,800-ish level. All-time closing high, I think, is 47.96. Intraday is 48.18. But you can tell with this kind of price action, Oliver, if you're a technician, if I didn't have any money in the market and I walk into today with the S&P at 47.70, it might sound funny, but I'd rather buy the S&P above 4,800, not right here. Your upside is capped from a technical perspective up to that resistance level. If you get above 4,800, your downside is capped to the potential support level, at least theoretically speaking. Same thing with the Russell. I would rather be in the Russell above 2,000, at least from a technical perspective, rather than take a stab at it right here, knowing that resistance still appears to be 2,000.
Yeah, we've kind of bumped into that level a few times, got rejected. It seems like also, unfortunately for the index bulls and the passive investors, S&P kind of struggles at some areas too. What would you be impressed by, Nate, either vol or stocks, on how we go into the weekend?
Well, I'd say watch the closes. That will give you a sense of where sentiment stands. At the end of the day, do investors want to be in stocks or out of stocks? We've had some nice, solid closes sans today, but I would say at least we're not closing at the lows of the day today. We've recovered quite nicely. If you get some sharp pullbacks or retreats and you start closing near the lows of the day, that can be a little bit more troublesome from a price action perspective. But now it's going to be about earnings. With the financials, though, the setup isn't that great. I was on Fast Market earlier, and something like a JP Morgan, hey, the stocks rallied 26% since October 27th. We had a number of big bank analyst downgrades this week prior to them reporting their earnings. We've got the negative RSI divergence in It's basically everywhere, guys. So that's something to be mindful of. And, it's just, we're going to have to see evidence of that soft landing via earnings growth, which has come down from about 7% a couple months ago, which was estimated, to now it's just below 2%. On the one hand, you could say, hey, that sets the bar low, so that's good news for the bulls. On the other hand, you could say, well, we'd like to see that growth because we're looking for, double-digit EPS growth in 2024.
All right, well, we're going to get the start of that tomorrow with the earnings kicking off. We'll see how that growth shows up. Appreciate it, guys. Great convo. Cooper Howard, Nate Peterson.